Hi everybody, David here. Hope you're well and Happy New Year. Yes, it's already past January. And I intentionally waited a little bit this year. I wanted to wait until we had our first FOMC rate decision, which just happened this last Wednesday. We're going to talk more about that. But this was a big week. We're going to do kind of a combination of a year in review for 2022 and a little bit of my thoughts of what's going on now and for this year. And so there's a lot of theme of kind of, the Mark Twain saying history doesn't repeat itself, it rhymes. There's a lot of rhyming going on. Same themes, kind of inflation, interest rates, recession, those types of issues that are carrying over into 2023. But again, this was a big week for lots of reasons. You had Jay Powell, Fed Chairman Powell, talk about raising interest rates 25 basis points. We're now at 4 3/4 level, probably on our way to 5%. Had a lot of big earnings this week with Apple, Amazon, Google, Starbucks, Ford, actually all missing. I'm actually recording this after hours on Thursday, and they all reported. So it kind of goes in line with a lot of things that have been happening with slower consumer, slower economic growth, those types of things we'll discuss in further detail. But let's talk about 2022 for a minute. Tough year for sure. You had the worst stock market since 2008, since the financial crisis. You had the S&P 500 down nearly 20%. You had the NASDAQ, the technology-ridden index, down over 30%. You had a balanced portfolio of stocks and bonds down nearly 20%. You had the bond market, the average aggregate bond market, which is a mix of corporate bonds, treasury bonds, those types of bonds, down about 13%. And you had long-term treasury bonds down over 30%. So it was kind of a mess for kind of a buy and hold investor, especially if you owned a lot of bonds, which most clients do. I call it the boomer portfolio. We've not been big bond fans. They're looking a lot more attractive now. We'll talk a little bit more about that. But that was a really difficult year. And so having 2022 behind us is kind of a good thing. We have to look at the times we've had 2 negative years in a row, which doesn't happen very often. Basically since 1928, it's happened 4 times. It happened during the Great Depression, World War II, the oil crisis in the 70s, and then of course the technology disaster, the tech wreck in 2000 and 2001. Let's hope we don't have a repeat of that, because what happens every time when you have 2 negative years in a row is worse than the first year. I think the average is down about 20-25% in the next year. So let's cross our fingers, hope we're not in store for that. But again, we have the similar themes. We've got the Federal Reserve, which we'll talk a little bit more about. We have inflation as a concern, of course, interest rates, recession fears still. So let's talk about the Federal Reserve, because unfortunately, that is driving a lot of the drivers still of the psychology and of markets right now is the Federal Reserve. We went from basically 0 interest rates to almost 5%. We're now at 4.75 on the federal funds rate, which is the short-term interest rates that drive, car loans, credit card debt, the prime rate, treasury bond yields. So the good part about that is that rates are higher on your savings accounts, money market accounts, and in bonds. So bonds are an attractive area right now we're looking at. We have a lot of clients in short-term treasury bonds right now, as you probably know, which we like as kind of a place to park. But again, we'll talk more about that. But on the Fed, I think that the Federal Reserve, probability-wise, is going to raise another 25 basis points, get us to that 5%, which is kind of called what's called the terminal rate, which is the rate where that he feels that the economy can handle. I'm not sure about that. But the market feels a little differently. Chair Powell has said that he's going to keep rates sustained at these high levels through the entire year of 2023. And what's going on right now is kind of a game of chicken between the Federal Reserve and the market, because the market's prognosticating that in the second half of the year, particularly the fourth quarter, that the Federal Reserve will actually start reducing interest rates down as much as 1%. And so I'm not sure. The problem is that the Federal Reserve lost a lot of credibility when they didn't raise interest rates back when we had inflation, when that transitory term was used inappropriately and myopically, in my opinion. And now they're having to save face by keeping rates higher, going at a much faster pace. It's the highest pace, the fastest pace of rising interest rates we've ever had historically. And so we're only seeing the effects right now in the housing market, in the interest rate market, in the mortgage market. It hasn't really trickled through all the way, to the real economy. You still see unemployment really low. We'll discuss that a little more. But that's going to be that. It's kind of this collision course between, are we going to go into recession? Can we hold the labor market up? Because even though we had a technical recession in 2022, which basically is defined as 2 consecutive quarters of negative GDP, we didn't have a labor recession. Unemployment's around 3.5%. That's low. Basically, we've gotten back all the jobs that we lost during the pandemic. And so the labor market's been stubbornly good, which is a great thing for our country. But if you're Jay Powell and you're trying to reduce demand and you're trying to reduce this wage inflation, it's kind of a problem. So it's kind of a game of chicken going on between, is the Federal Reserve going to blink first or the market? And right now the market is thinking that Chair Powell is going to reduce interest rates in the future sooner than later. So the Fed is still front and center. Inflation is still an issue. I think we had peak inflation last May of a little over 9%, almost 10%. That's now come down to just under 7%. That's pretty good. That's a pretty good clip. We're at 25, 30% reduction in inflation. The problem is Chairman Powell wants to get inflation down to 2%. He said he wants to see that like on a 3 to 6 month average. So not just one time. So that would push us probably most likely to see that into next year, but we'll see. When you have, I remember back in 2008, we had inflation around 5%, and then we had deflation. We actually had negative inflation, which is deflation back in 2008, 2009. So that can happen. I think it happened in like 9 months, something like that, 6 to 9 months. So who knows, we may be on pace for that. The market will perceive that as a good thing. So inflation is still a concern, it's still a problem, just like 2022. And then recession, of course. Are we going to enter a true recession? Again, we were in a technical recession in 2022. The probabilities are high that we're going to enter recession this year. The labor market needs to participate. We probably have to have unemployment go from 3.5% to closer to 5%. I think secretly that's what Chair Powell wants to happen. He won't say that publicly. He did use the word pain last year at one of his FOMC meetings, saying there's going to be a lot of pain. He was a little more docile this last meeting, and the market kind of liked that. So, we'll see. But from a macroeconomic level, you look at leading economic indicators, what's called a inverted yield curve, where you have higher interest rates. The short-term interest rates are higher than long-term rates. Those types of things, which are kind of garden variety signals for a recession, are there already. We're seeing slowing. All the earnings I listened to tonight from Apple, Amazon, Starbucks, Ford, a lot of the companies, it's consumer demand. Whether it's advertising, whether it's coffee, whether it's automobiles. And so we're declining, there's no question. All those leading indicators are going down. And so really it's this race to where do we get to, if the labor market can hold up and we can get through this inflation and get to the other side, that's what, quote, the soft landing that people talk about if you hear that term. And so we'll see, that could happen. It's a low probability outcome in my opinion, but I'm hopeful. So that's one outcome. So we've talked about recession, the Federal Reserve, inflation. I think for us as a firm looking forward, we still have to be very cautious. It's not all clear. It's hard to be real aggressive, especially on the stock side, when you have still rising interest rates. Markets are forward looking, so we're looking ahead. But there's going to be some opportunity, but we still have to be careful this year like we were last year. Last year, quite frankly, I think it was a lot easier. It was a little more of a tell in the sense for me personally and at the firm level that the market was going to have some more trouble. Now, we couldn't predict the war in Ukraine, all those kind of things, but just from a valuation standpoint, it felt frothy after all the stimulus from 2020, 2021. The market felt really overvalued, and it's still a little bit overvalued in my opinion right now. So I'd like to see a little bit more decline in the stock markets to feel more comfortable, or more stability. And we've had a little bit more stability, really, if you think about it, since really October. Kind of that's been the low so far, S&P 3,500. And so we've kind of bounced around the bottom, come up quite a bit in the last 3 or 4 weeks. But it's still kind of what I call a show me market. I want to prove it to myself, in the sense that, okay, do we have stability? Do we have another leg down in the market? I think that's still to be seen. So we're still remaining patient. We're still going to use our tried and true strategies, our dividend strategies, our real estate strategies, our other strategies, annuities, if those are appropriate for our clients. And but that's about it. If you want to reach out to me, I've spoken to a lot of you. I'd love to hear from you. If you have any thoughts, questions, or concerns, reach out to me. I would love to see you. So again, Happy New Year, and I'll see you next time.